Awesome. We can get started, and then the rest of the participants will join in as and when they, get on this webinar. Great. So, as you all know, I'm the innovation specialist with the GFI India team, and the context for today's webinar is the fact that a lot of participants have been going through SciTech workshops. You've gone through a lot of scientific resources, also our startup manual, the state of the industry reports in phase one, right? And a lot of you had questions about how do we really get funded in this sector. If we are looking to raise investment, what kind of products do usually investors prefer? What exact key things are they looking for in a team or in a startup that is usually looking to fundraise? Different kind of stages of fundraising. Even if you're bootstrapping, what are some key perspectives to keep in mind if you decide to raise at a later date, especially VC funding? And then there were a lot of questions around, let's just say this area is very tech forward, right? And obviously there are a lot of unknown variables in the Indian market, including market size, marketing to consumers who have not really seen a lot of these products out there in the market. So it's not a commodity at the end of the day. So given all of that context, we figured the best speaker to help us with some of these insights would be Shruti. Shruti Srivastava is a principal at Omnivore, and I'll give you a quick introduction about Shruti as well. But before that, I just wanted to tell you that we've been obviously working closely with Omnivore just to understand this space a little better. And Omnivore is one of the largest agri-tech funds in India, right? And they've been working with a lot of tech-forward companies in the agri-food space, especially the agri-tech space. So Shruti has a lot of insights, and she has also engaged with a lot of startups in the early stage ecosystem in India, and also with a few international companies in the smart protein sector. So she has kind of an understanding of where all those startups are. And at the same time, we've engaged with Mark Khan and Shruti on multiple occasions. You might have seen the GF Ideas India webinar on our YouTube channel, or you might have seen recently done CII co-fireside chat where Mark and Varun spoke on something similar as well. So given that, we have tried to make this specific session specific to our sector and the food sector in India in general, because there are not enough comparables, for our sector in the Indian market, not enough established companies with a lot of products in the market. So we figured it might be a good idea to give you some context from the CPG space as well, consumer packaged goods space as well. Having said that, I'll stop my screen share and quickly give an introduction to Shruti. Shruti is a principal at Omnivore, where she evaluates and manages investments in food and agriculture technologies, innovative foods, and rural finance. Prior to joining Omnivore, Shruti worked at Acumen, a global impact-focused venture fund, where she led the fund's clean tech investments in manufacturing, agribusiness, and service sectors across Southeast Asia and Asia regions. Shruti graduated with a bachelor's and master's in electrical engineering from IIT Madras. And obviously, like I said, she's one of the best people out there who kind of understands the context of the sector, especially the Indian context. And we are hoping to learn a lot from you, Shruti. Thank you so much for your time today.
Thanks, Shardul, for the introduction. That was very kind. How many participants do we have on this? It says 71, 72 right now. That's interesting.
Yeah,
Quite
yeah.
many people looking at this space. As Shardul mentioned, I work with Omnivore. We are an early stage venture fund that typically invests in the seed to Series A stages for companies that are looking to move the needle on profitability, sustainability, and resilience for how food and agriculture ecosystems function in India. Our interest in alternative proteins comes from the sustainability piece, which is an important pillar of our investment thesis. We actively recognize that the environmental impacts of livestock-based agriculture are quite significant, and mitigation strategies for protein, livestock-based protein production is something that Omnivore seeks to actively back. As Shardul mentioned, we've been engaging very actively with GFI for over a year and a half now on various initiatives to help build out the ecosystem in India, and happy to connect with all of the folks here who are looking to build solutions along this theme. I'll just share my screen now. Just give me a second. So the objective of today's engagement is to effectively understand what investors see in the smart protein space, what excites us about the space, what are some of the risks and challenges that we continue to see, and what are, potential avenues to explore and keep in mind as you look at building out your smart protein business. Great.
So yeah, perfect.
Just give me a second. Great. Okay. So to begin with, firstly, I think while we all want to talk about what investors like in the space and why certain things are important to investors, it's also important to note that investors like certain things because they are interesting for the business and because they work for the kind of capital class that VCs are bringing to the table. We've often said this on multiple forums that venture capital as a financing instrument is suitable for a very small subset of startups, because VC as a class looks for extremely high growth, high risk investments, and so the expectation is of supernormal high returns. So anything less than 10x does not really work. The reason for that is we take very high risk bets. We do know that 60-70% of those bets are not going to amount to anything, and so we need the remaining 30% to not only make up for the tanked 70% but also to return the overall fund returns that we have promised to our investors. And so a lot of things that I will talk about today are general about business with specific nuances on VC perspectives, baked in. And I will make those distinctions wherever such situations arise. I hope that's fine. So let's look at the market itself and what excites investors like us about the smart protein market. Whenever we're looking at a potential startup idea or a theme, we look at how large the market is going to be. Right? If it's a very small market, it's great for a business to work in a small market. For an investor to really make returns, they need the market to be a very large market, preferably upwards of $1 billion. If you look at the smart protein market in India, we believe largely you will see the market comprising of two segments. There is the replacement penetration that you will see among conventional users, and then you will see some conversion amongst vegetarian users. This is largely how the market developed in the US as well. However, there's one nuance for Indian markets here, which is that vegetarian users do not necessarily want a replacement product. And so you need to think about what percentage of those vegetarian users will be willing to convert to different kinds of smart protein products, which again depends on the kind of product that you're bringing to them. So to do like a small sample exercise, we did this for eggs. If you look at the conventional egg market, it's about an annual $6 billion in sales. And if you look at the kind of penetration of alternative proteins that has happened among conventional users in Western markets, we can expect a maximum penetration of about 5%, given that the conventional egg users would fall in all kinds of income brackets. On the other hand, if you look at the amount that India's protein deficient vegetarian population spends on protein sources, that is upwards of $10 billion. So if you put the two together, you look at a market which will be closer to $800-900 million, which works out pretty attractively. You could also look at tapping into markets outside of India, depending on the kind of products you're building. What also excites us about the smart protein space today is the drivers and how it all ties in with the readiness of the market. So we've been seeing an increase in incomes. Households are willing to spend more on consumption of products that help them either with health or with convenience, which in fact has seen the growth of many startups in the consumer product space. There's also an increased understanding regarding ethical consumption. For India, a lot of that was driven culturally over the last few centuries, but that has also gotten compounded with the understanding for increased protein intake. The timing is very interesting because um, you have a population that is willing to experiment more with food, and which makes it an appropriate time to introduce something like this to the Indian population. There are also enabling ecosystem drivers which help in getting the timing right. The advent of e-commerce and third-party logistics has made a lot of FMCG operations easier today than it was for the ITCs and the Unilevers when they were just setting things up. The advent of social media again makes getting the messaging across far more capital efficient than it would be if you had to, buy airspace on television advertising or out-of-home advertising. Um, there are also tailwinds that we see in September 2020 that are very ripe for smart protein startups to take advantage of, primarily driven by the pushback on conventional animal protein rising due to COVID-19. And we will see a greater consumption, a greater shift towards plant-based protein in the coming years. There are also potential headwinds that we need to worry about, and this again is something which is very recent as a week back, about regulatory pushback. So the dairy industry has seen this time and again in India. There was the whole ghee versus vanaspati debate in the 50s, 60s. There was the battle that Unilever and Vadilal fought with Amul about what is ice cream versus what is frozen dessert over the use of real dairy. And how we choose to write those, how we choose to tackle with those headwinds is again something that investors would need founders to think about. Tailwinds are interesting, headwinds not so much. The other nuance that worries some of the investors about the market, and which would require founders to be a little smart about approaching this sector, would be how consumption in India differs from consumption in the West. The smart protein success story has largely been driven by consumption in the US, where the requirements for what meat needs to be are much higher, right? You need, people have meat rare, which means you need different kinds of texturization. You're looking for effectively a burger that bleeds. India, on the other hand, marinates the meat to death, very literally. And so you are not really looking for chewy muscle fibers. You're looking for something which is much softer and much finer. And so ensuring that the product is more tailored to what consumption is like in India becomes important as well. Um, uh, Additionally, meat consumption in India, even for conventional meat eaters, tends to be, a few days a week, whereas that's not really the case how it was in the West. So some of those nuances need to be thought about as well when we look at understanding what kind of markets we want to target here. The other theme which excites us about the global market and how India fits into that global market is about how India is effectively a production ground for very cost efficient protein sources called pulses. And if we could figure out how to process those pulses for better bioavailability of protein, to process them into products which have a much wider acceptance for global taste palettes, there is essentially a play for building products in building food products in India for export markets. That's another theme in the market that really excites us today. From market coming to product, it's important to think about what kind of product you're driving, because that effectively impacts the size of your market, and it impacts the size of, it impacts the channels that you will use to distribute. It impacts what your differentiation needs to be. When investors evaluate product, we look at who the product is targeted towards and what's the core value proposition, right? So if I look at, so if I am evaluating a company in the smart protein space, I would try to understand whether it is a high protein, ready to eat, ready to cook, ready to consume item that's being offered directly to consumers. Is it something that's trying to fulfill the functional properties that proteins like, say, milk or egg fulfill in finished products? So if you're talking about eggs, for example, you'd need something that can work as a binding agent, something that can create the rise that you get in cakes. Or are you looking at something which works as a full spectrum replacement, right? Something like for milk, there's this company called Ripple, which was making pea protein based milk. And one of the biggest challenges that alternative milks had seen, especially if you look at desi consumption, it was how you could not boil it, and how you could not make chai out of it. In India, chai continues to be a very strong use case for milk consumption. And so what's the core value proposition that your product is bringing to the table is something that we would evaluate first and foremost, right? Then we would look at who is the customer that is being targeted. Is this a product that goes directly to a consumer? Is this a finished product? Is this something that is more targeted to be sold to other businesses? So for example, ingredients that are high protein ingredients that are going into other finished products, right? So the likes of, say, an Ingredion or a Roque, they manufacture ingredients which go into your alternative burgers and potentially other products as well. We would look at, because the strategies for accessing B2C markets and B2B markets become very different. Your cost economics change, your channels change. And so VCs tend to like B2C businesses better because of a potential brand-based acquisition play. That's been the case in the US. In India, while we have seen a lot of activity in the B2C consumer products space, everything is still very early, and the jury is out on whether the cost economics for a B2C play are effective or not. There are some companies which have built very exciting businesses. These are not smart protein companies, but pure play consumer product companies that have built strong, promising businesses in this category. For B2B businesses, the lens that investors use to evaluate the product changes a bit, because then we are looking at differentiation. Consumers pick product based on what they like. It is less rational and more emotional at times. B2B, on the other hand, works on very strong math for most B2B buyers. And so your positioning, everything starts to change. Things that help a product company succeed often hinge around differentiation. And just like any other company, differentiation becomes important in the smart protein space as well. Your differentiation, especially for a startup, comes um, chiefly from having process technology that is completely your own, and which gives you some sort of a competitive edge. So if we look at companies like, well, um, Myco, which has created process technologies for uh, driving functional ingredients out of mushrooms, right? Um, there has to be some sort of differentiation or some sort of uh, IP or trade secret, which becomes difficult for other competitors to copy. And that's what gives products their edge. And investors definitely like to see that there is a strong differentiation in the product. And that differentiation is supposed to drive either better customer connect, better customer acceptability, better cost economics. So for example, if you're building something and your process tech is such that you able to say bring the cost of alternative milks down to say 30% lower than the cost of conventional milk in India, right? That gives you a very strong competitive edge. um, the other aspects that we often look at are stage of readiness, how much further along the company needs to go for the product to really hit market. What are the things that will need to be built in, what are the things that need to be tweaked, has there been initial testing done, what's been the kind of feedback received. And this becomes extremely important for all kinds of business, very much so for food businesses, because eventually for all kinds of food, whether it is an ingredient going into a B2B company or it's a B2C product, food, everything comes down to three things: taste, taste, and taste. And so if you have done your initial testing and the feedback received was negative on the taste, that becomes a cause of worry, because people take the only thing that people will continue to consume, even though the taste is horrible, just because it will help health, is medicine, not food, right? And we've seen a lot of healthy products or better for you products uh, struggling because they've not really gotten the taste aspects right. And so initial testing and the feedback received on that becomes extremely important. um, when we talk about product, who does the production also matters, right? And this becomes tricky, especially if you have some sort of process tech that you want to keep in-house, and manufacturing itself is not something where equity is the best use of funds. And so you might need to figure out what kind of production partnerships need to be forged. It's usually easier to go for specialized producers who have smaller capacity for your needs initially, and who don't really have competing B2C businesses. If you're a B2C business, having production partnerships is easier because those companies usually see themselves as, as manufacturing partners or as production partners, and they shy away from really moving on to uh, end consumer products. However, if you're an ingredients play, then there's a direct conflict between your production partner and you. And so that's something which becomes tricky, which the company needs to figure out. And it would be something that VCs would effectively stress test. Coming to the third most critical piece that becomes important when we evaluate a business like a smart protein business is how are you looking to get to the customer? What is the channel you're going to employ or going to use for your distribution? If we and this again varies whether you're a finished product company or you're an ingredients company. As a finished product company, you can use retail channels. There are three main retail channels that people target, that people access in India. There's general trade, which is your kirana and specialized kirana all put together. There's modern trade, which is your large format uh, mm, departmental stores, which chiefly specialize in grocery and provisions. And so your Big Bazaar and more and such hypermarket chains would fall in this category. And the third most popular one tends to be e-commerce or e-retail, which includes your Amazon, Flipkart, Big Basket. All three of these have their own pluses and minuses. Um, with general trade, the advantage is that your cash cycles, your working capital cycles are a little better because you work on a bill to bill model, and you don't really have a lot of you don't need to pay any additional margins to the retailer for your product. But at the same time, general trade stores have a much smaller footfall. The format of the stores is often not great for new product discovery. People usually go to general trade for buying things that they know they need, and just they buy it and they come back. It's not a great place for discovery. At the same time, bulk of retail trade volume in India, especially for food, still goes through general trade. And so it is a channel that you need to be present in, but maybe not at the beginning. Maybe as you look to expand a couple of years down the line. The second channel, which has been the most popular channel for introduction of new products, is modern trade. The format for modern trade is such that product discovery becomes possible, sampling becomes possible, which is another way of getting consumers acquired. The average footfall of a modern trade store is several times higher than that of a general trade store. And so for the same amount of sales, while you might need to be present in 100 general trade stores, you might do this with 2 modern trade stores. And for this particular quality, modern trade stores will tend to charge you a higher margin for letting you be in their store. They will also often charge listing fees from you. Um, and they have a much longer payment settlement cycle, and so you have a fair bit of cash that often stays locked in the system, because your payments will come after 45 days if you're very lucky, 60 days on an average for folks like Big Bazaar still waiting. um, the third attractive channel is e-commerce, and the reason it becomes attractive is because the reach that it can give you is even higher than modern trade, right? For modern trade, at least you need to keep adding one store. For e-commerce, it's a single platform that will give you a much wider customer audience. The economics are slightly better than modern trade, but still you will end up paying somewhere close to like 25-30% margin in most cases. Logistics challenges can at times get addressed because the e-commerce players have their own logistics fleet, and you can end up piggybacking that, but then that's an additional margin that you need to pay to them. Um, the Some of the players like Big Basket and Amazon have accelerators and launchpad programs. So there's BB Accelerate, which is a section where they showcase newer, consumer startups. Amazon has Amazon Launchpad, where they showcase similar startups. These are great ways to, have to attract more customers. And again, the cost benefit analysis needs to be worked out depending on what kind of product you're selling. The second channel, which used to work very well for various companies in the past, and for some of the meat companies in the for some of the alternative meat companies in the US, was Horeca. Uh, Largely your restaurant channel. While the Indian consumer got willing to experiment with food, most of the initial experimentation has always happened in out of home consumption, right? It would be uh, uh, through casual dining chains, through fast food chains. That's largely been an introduction platform for a lot of newer cuisines that were entering India, newer ingredients that were entering India. And so Horeca, before COVID shut that industry down, was a great channel to explore. It could again be once the sector starts recovering. So the jury is very much out on how useful that will be as a channel. And sometimes for similar and competing products, people can choose to have different distribution approaches. So if you look at Impossible, they chose the restaurant route for introducing the product and for getting to consumers. Beyond Meat, on the other hand, went the retail route. And so both can work for you depending on what channels you have stronger relationships with, what channels you understand the dynamics better for. Um, the two new channels that seem to be emerging for consumer products distribution are social commerce and direct to consumer. Social commerce would be platforms like Misho or Trell or a whole lot of others that have come in, even pushing sales through uh, Facebook Marketplace, which is active now. Um, the reason social commerce is interesting is because for something new, influencer-led sales and targeted sales often work much more efficiently rather than broad-based advertising. And so for an introductory phase, social commerce platforms can be a great avenue as well. For most of them, margins again seem to be in the 25 to 30% range, and you have to figure out whether that works for you or not. With D2C or direct to consumer, own website sales, or a mix of website plus own store sales, the advantage is that you have a much better working capital cycle. You get payments upfront. The trick here is to drive traffic to your own website and or your own app. And some companies in India have done that very, very smartly by using uh, community-led lead generation, by leveraging social media very efficiently. So one example that immediately comes to mind is this health supplements brand called Oziva. They started with plant protein based meal replacement shakes and protein shakes, added other health drinks on top. They're now doing collagen builders. And they have driven sales by burning very little cash, largely through their own website, using social leads very, very efficiently. And so for finished products, what investors largely want to see, what I would largely want to see is how do you drive sales in a very cost efficient manner, right? It's easy to drive sales by just burning piles of cash and fire. But if you're spending $10 in advertising to get $2 in sales, that would scare that's not a great metric for us, right? That's not something that is sustainable for the business in the long run. And so efficiently using a mix of these various distribution channels and choosing the right channel for your kind of product becomes extremely important. um, the strategy, the channel strategy becomes very, very different when we're talking about ingredient companies. For ingredient companies, you can work one of two ways. You either work with a third party distributor who is then connected to, end buyers like a Unilever or an ITC or an Impossible in the US or a General Mills. um, these guys, so the advantage for a startup to use a third party distributor is that you don't have to go about knocking on a lot of doors on your own. You need to crack two distributor relationships and they can then open other doors for you. Of course they charge a much higher margin for that fee that they're offering, but for a smaller company that's just starting out, going the second route, which is building out your own sales force, becomes a little difficult. Unless you already have very strong relationships with end clients when you are starting your business, and you wouldn't need a third party distributor to open doors for you. The challenge that we often see with a third party distributor is that you often will not have a very strong relationship with your end consumer. However, if you have a very strong process driven product, then the product might help in cementing some of that relationship. Um, Building an own sales force is a great idea in the longer run, but in the beginning, when you are not when you are also still figuring out which are the large customers to track, building out your own sales force can take a lot of cash without really showing much for it. And so that's something to again be careful about. At the same time, if you're working with a third party distributor, ensuring that your competitive edge, the distributor doesn't effectively kick you out all that easily, because your competitive edge from the product needs to be very, very strong in that case. And if you recall the previous two slides, you would have noticed that the market feeds what the product should be, and the product itself determines the segment of the market you need to go after. The market you're going after determines what the channel should be, and your choice of channel often will determine who your target customer would be. And so while we often talk about product market fit, product market channel fit together is what you need to strive towards, right? And so the zone of operation is somewhere where all three intersect. The product, channel, and market together need to be in coherence for the business to be really attractive. I would just pause here for a few questions in case anybody has anything.
Yeah, thank you so much, Shruti. I think what we've covered till now has been certainly very insightful and helpful for all the participants who are thinking about a lot of these things. And like I'll just like to add in some more context. Sorry, some more context, right? I mean, you've seen the evaluation criteria, and I know a lot of you might be thinking some of these things are not directly going to go into your ideation proposal, but like Shruti said, all of these factors you have to really keep in mind when you're defining your problem statement, for a competition like this, so that you can have optimized ways of thinking and strategizing about how your product would look like, what your process would look like, how you're distributing it, and you kind of take all of those insights and then work towards thinking what problem should you even be solving. So given that, I think if you have any questions for the slides till now, please submit them through the Q&A button, or you could also DM them to me via the chat box. If not, we can actually continue and then we can take in the questions at a later date, since I don't see many questions. Shruti, but there were some questions submitted from the registration form itself, right? And I think a lot of these would be pertinent towards the later part, like how does a startup would really pitch to investor, what key things are really being looked at. So I think we can get to those a little later. So maybe
How
we
much
can
time
continue.
do we have right now?
So we have a lot of time. We have this session from 6 to 7:30. So we have 45 minutes left.
Great. All right. Cool. Okay.
Yeah, so can you, I think there's a question about, and this was a great insight as well, like when you were talking about B2C versus B2B, and how should a startup really think about those two channels and customers therein. And, how does a VC really think about funding a B2B business in India in CPG space versus B2C business?
Sure. You want me to take that right now or towards the end?
Yeah, you can take it now.
Okay. So both have their pluses and minuses. With B2B, it is, especially with respect to food, it is more driven by a strong value proposition. B2C, on the other hand, is about consumer psychology, which tends to be a mix of rational plus irrational, whereas B2B purchase decisions are more rationality driven. And so the value proposition becomes much clearer to understand there. For investors, for VCs, we make money depending on what can cause very strong growth. And for B2B companies, for a VC to be interested, there needs to be very, very strong process driven tech differentiation, uh, because otherwise it becomes you know uh, a commodities manufacturing business. And a commodities manufacturing business then grows as a function of manufacturing capacity. And for manufacturing capacity, it's very linearly associated with the capital that you're putting in. For VCs, the investments that they look at, and the ones that make sense for them, are investments where you can drive exponential returns based on, or exponential growth based on the capital that you are putting in. And so for B2B, if there is a very strong technology play, it becomes interesting. Otherwise, it is something that is more relevant for a private equity investor to look at, or something which should be financed using debt capital. Um, B2C,
Yeah,
on
makes
the
sense.
other hand, yeah, B2C, on the other hand, in India, the consumer product space is still a little nascent. We have very few companies that have really, broken out, and people are still learning on what works, what doesn't work. With B2C, the brand association with consumer is something that is much fuzzier to define. But because it's fuzzier to define, it's also tougher to take away. And so with B2C, there are many, many things that you need to get right. You need to get the messaging right. You need to have the right customer connect. You need to have a product which in the case of food, tastes well, and you need to have a product which is not like completely similar to what the other people are selling on the same shelf. And you have to effectively drive a differentiation in the mind of the consumer. That is easier said than done, but because it's difficult to do, that gives you a very natural competitive edge. And so in that case, your growth is largely driven, it's a very product led growth, and um, you're valued for the brand value that you start creating, aside from the revenue value. And so it depends. Different investors would view both differently. There are lots of investors who would not look at CPG because it has a very different growth profile compared to, say, tech platforms. And there are several VCs who would look at CPG exactly because of this growth profile.
Yeah, that's a great answer. I think that weaves in a lot of insights and would possibly cater to a lot of questions which were on similar note. I think there's one more question. So, startups when they are early stage, especially if they do not have a strong financial backing into their venture, they think that going for Horeca, and again, this is a food distribution, food manufacturing business. It needs a lot of network. It needs a lot of investment in terms of getting the word out there to different restaurants, canteens, QSR outlets to get their products, and that takes a lot of time. And they think to get started, like all of these new age startups, they do directly through social media or build their D2C platforms and then start delivering. So obviously the context in US is different, and the one in India for going D2C versus going through a Horeca channel is different. Could you shed some light on that, on given this context?
If you'd asked me this 6 months back, my answer would have been fairly different. Yes, cracking restaurants takes time. And you also need to crack the right restaurants. So chains preferably versus, standalone places. Um, D2C, so this whole, driving sales from your own platform, most Indian startups had not really cracked that very well. However, in the last 6 to 8 months, I'm actually encountering startups which have figured out how to drive leads to their platform in a very, very cost efficient manner. And so, yes, it's possible to do that. It's possible to do that because you have a lot of enabling infrastructure available today. You have third party logistics available to take care of the logistics challenges. You even have tools like Shopify, which help you with the digital storefront. You have uh, an Indian population very much hooked on to social media, and so if you use that to efficiently drive leads to your platform, it is possible. It is possible. You just need to get these 4 or 5 things right.
Got it. Yeah, makes a lot of sense. I think we can take one more question before we continue with the presentation, which talks specifically about how VCs evaluate this sector. I mean, some sectors are inherently tech forward, like our sector, and obviously sometimes the gestation cycles are quite longer. So, could you throw some light on this whole business of exponential returns? What are the timelines usually that you envision a company to start delivering on your investment?
So typically the time frame for a venture investment tends to be 5 to 7 years from the time that they've invested. We look to exit the company in 5 to 7 years, which means that in 5 to 7 years we expect the company to be at a stage where somebody finds our shareholding in the company valuable enough to acquire, and valuable enough to acquire at a value that makes good returns for us, right? Which means that yes, the growth will need to be fairly steep, or you get valued for an inherent technology that you've built. In India, we have not seen tech IP based acquisitions happen so far. um, I still wish for the day that stands to change, because we do see that happening in other geographies, and I'm still very much an engineer at heart. So would definitely want to see that change someday. But in the foreseeable future, that is unlikely to happen unless and until somebody really comes up with a knock your socks off kind of tech differentiation. And
Yeah,
in that case, we are not talking about minor process tweaks and trade secrets and getting the temperature right kind of stuff. We're actually talking about some active molecule suppression. We are talking about we're talking about things which will be more in the biotech realm, or at least a greater degree of food science IP. And
got it.
we've not seen much of that happen in India. So the exit will be based on the sales that the company has managed to do in those 5 to 7 years, right? And so the entry price for us becomes important, and the sales that the company is able to drive in 5 years becomes important.
That's an excellent insight. And I think just to give some more context to participants, a lot of you have discussed this with me in the past, attendees. Like 70% of our challenge participants come with a food science, agri science, bioscience kind of a background, right? And I think this insight just stresses the importance of having technically strong team when you're looking to start a company in this area. And not just being a founder who's looking to outsource this course IP bit, because a lot of these investors are gonna, especially in the VC space, are gonna look at your functional ingredients, how much of it is replicable, how much of it could be IP protected, etc. So those are excellent insights. I think we can continue with the deck for the time being and then get back to questions. Meanwhile, please
That's a
feel
great
free to submit
segue into
questions.
the next, segment. So, the process IP and the differentiation is effectively what helps you ward off competition. And so when VCs evaluate a business idea or a startup, we look at the overall competitive landscape. We look at who the incumbents are. Because the incumbents are your first competition. The new players who are trying to do what you are doing are secondary competition. The biggest competition will come from incumbents. So for a beyond or an impossible, more than each other, their biggest competition was the Big Mac that was being sold across the country. And understanding the advantages and challenges that the startup faces vis-a-vis the incumbents becomes very important. And the incumbents have some home ground advantage because they've been embedded in the space for a while. They are the ones who have the existing say distribution relationships. They are the ones who the consumers are currently consuming. And so understanding how you fare versus the competition, versus the incumbent competition, becomes very important. We also look at the kind of barriers to entry. If it is something that a lot of people can very quickly do and get to the same stage as you, that makes it a very difficult market, right? Too much competition too early on for new players, it also spoils the market. And while there are several VCs who are still comfortable with those kinds of competitive dynamics, we get a little worried because the minute you have very low entry barriers, you have too many players flooding the space. And a lot of times in such scenarios, it's not really the best product that ends up winning. It's the most discounted product that ends up winning. We've all seen that happen over various case studies across the past decade. And so um, barriers to entry to get to the point that you are need to be high. Usually technology differentiation tends to serve as a fairly strong barrier to entry. The second barrier to entry that helps once you're a little bit further along in your development cycle is your relationships with early customers or early platforms. So for example, if you've had like a 6-month runway on Amazon already, or you've driven a lot of organic traffic on your website already and push sales through it, that gives you some sort of a lead time advantage. But understanding the barriers to entry, especially to get to your level of product, becomes very important. And so investors like to see things that are differentiated. And so we would compare the company on, product and cost economics, what are the distribution related advantages and disadvantages, what is the kind of customer connect that the startup has, becomes very important as well. Because great companies also often struggle to survive in the face of competition. And understanding the competitive landscape is something that's very critical to investors. The other thing that we often push founders on with respect to competition, a lot of you would have seen this 2x2 matrix that is used to describe competitive advantage. You would usually have the and everybody places themselves in the top right corner. And we often try to push to understand how well the founders understand the real competition in this space. And that also generates a lot of insights for both the VC as well as the founder. Understanding how easy or difficult it is for other players to do what you're doing will be very critical to your survival and growth in the longer run. Coming to team. So, especially for early stage investors, people who are writing the first check, there are 2-3 things that are very critical, right? The size of the market and the kind of value proposition being brought to that market is one. The team and its ability to execute is, the second. So I often compare this to a Formula One race. The market and the idea is basically the car, and the team is the driver. And if any of you folks follow F1, teams have suffered. When I say teams, the Ferraris and the McLarens and the BMW guys have suffered when they've changed drivers and the new driver hasn't been as great, or when they've lost drivers to other teams. And so the team is extremely critical, more so in the initial stages of fundraising, because in early on in the fundraising cycle, you wouldn't have a lot of track record to show for the company, right? If you're raising a seed round, you would have done sales for what, 3 months, 6 months, maybe 9 months. How much of attractive numbers can that generate, compared to say a series C round where you had 3 years of sales and those numbers start to speak for themselves. And so when I would look at a smart protein startup, I would look at what kind of skill sets and experience the team is bringing together. For a smart protein company, we want somebody who understands food science, who's worked in the space, who's built products for somebody else in the space, are all an added plus. But a core understanding of food science is definitely something that would be helpful here. And as you would have seen in the previous slides as well, since process differentiation is going to be a very critical part of winning in this space, we would really want the food science expertise to be internal to the team and not really be outsourced. The second very important skill set that would be relevant here would be the commercial aspects, right? It could, for a B2C company, it could be experience with a CPG company in sales and marketing. It could be experience in digital marketing. It could be experience in brand building. For a B2B company, we would want to look at somebody who's done enterprise sales before, right? If you're an ingredients company, you need to be able to work with large business accounts and drive sales through them. And the third skill that we often look at is the ability to manage operations. And a lot of times this overlaps with some of the other commercial skills, but in some cases it's good to have a very a person who's very operations driven, because there are a lot of aspects where things tend to slip when you are looking at building a business 0 to 1. And two of these are absolutely non-negotiable in the core team. The others can be added on later. A commercial lens and a food science understanding. I've often been asked a question around how large a founding team should it be? Sorry, is it bad to be a single founder startup? And what I often tell founders is that it's okay to be a single founder startup, but you will need to bring in people who can push you in the right way, who can be your own soundboard. And no one person has all necessary skills, right? And so investors like to see founding teams in the range of 2 to 4 people, 2 to 3 preferably. sorry, more than four tends to be a crowd. You won't have enough equity for each person in the beginning, and after a few rounds everybody gets significantly diluted, and then we worry that people don't have enough skin in the game. And so having a co-founder is also helpful, because building a startup is real hard work, and doing it alone can get very frustrating at times. In fact, more often than not, it will get frustrating. um, Also, when you are the founder, you will not have all the answers. You're building something new, nobody has all the answers, and you would need someone who can be your sounding board in such a situation. And so having a team becomes an important factor. We also look at the kind of passion that the team has for the sector and for what they are building. A passion. We also look for the passion to succeed. Right? Are these folks who are willing to give it their all and go the extra mile to succeed? That becomes important as well. And it's kind of while passion for the cause is important, passion for succeeding becomes equally important as well. And these are things we assess. While the first category, relevance of experience and skill sets, is easier to assess sorry, when you see people's resumes. The other factors are more easily assessed in, one-on-one conversations that we keep having with founders. So investors typically tend to spend more time with founders, trying to assess how they think, what is their approach to problem solving, how do they handle stress. We try to understand the passion for the space, the passion for building something, the passion for succeeding. We also try to understand how the team fits together, not just in terms of, complementarity of skill sets and experience, but also in terms of founder dynamics. Is there one person who will basically drive everything? Will the others have ability to push back? Is there mutual respect for each other's experiences and skill sets? And is this a team that can stick it out for the longer run? Do the team dynamics support the thesis that this is a team that will stick it out for the longer run, that will not just, work out on each other if things get tough? And the founding team also needs to have the ability to build a larger team to really execute the vision. And so networks and the ability to bring in fresh and relevant talent to work with them becomes important as well. These are largely things that we tend to evaluate.
I
Coming
have a
to
quick question there, Shruti. Actually, we see a lot of mission alignment, right?
right.
As a part of team or as part of founders. How do you really, how do investors usually think about mission aligned founders? And how do you really gauge their demonstrated mission alignment? Is it some past track record or just some thoughts around that point?
um, Well, interesting question. And unfortunately, there's no like framework to evaluate that. A lot of it is driven by observations of the team members' interactions with each other. Um, and so mission alignment itself can be it's a three-pronged mission, right? You're trying to solve a problem, you're trying to um, build something that lasts, and you're trying to succeed at it. I think passion for the cause without passion for success is not totally helpful, and passion for success without passion for the cause is also not going to be helpful, because then that person might just as well go and take an oil trading job somewhere. So usually we assess this based on conversations that we have, right? The more time you spend with people, the more you try to the better understanding of theirs that you get. Within founders also, we've often seen that there is a past track record in terms of people having worked together before, people having studied together before. If you look at most of the startup teams in India, you'll see a whole percentage of them have been friends during undergrad, and or people who grew up together, or people who worked together for a while. It's usually folks coming in from each other's networks, and so usually when such folks get together, there is some degree of alignment in what they want to build. um, we of course stress test that alignment based on conversations that we have with the team together and separately, and try to see if what they say together matches with what they say separately. um, it's it's very much people assessment driven, unfortunately. No strict framework for it. I'm not sure if
Awesome.
that
Yeah.
was.
No, no, that definitely answers my question. I also had an element of mission alignment with the sector, like really understanding the change theory and what we're really trying to solve for by building companies in the smart protein sector. But you obviously answered a very key piece of it as well.
So the mission alignment with the sector is largely, I would put that alongside the passion to solve the problem. So people get excited about a problem because it is a large problem to solve, and uh, the reason they understand it's a problem is because there is some sense of mission alignment. And I might have a slightly controversial view here, especially coming in from the impact space. But it's more important to have that passion for solving the problem, because that is what is going to drive the change. And uh, how do I put this better? Um, it's great to want to drive a change because of the understanding of ethical implications of the space, for example. But unless and until that is accompanied by the need to solve the problem, it becomes a little difficult. And I've seen a lot of people, and we see this in the agri-tech space as well. We've seen this in financial inclusion as well. Folks who really move the needle in those spaces hadn't necessarily set off to do a lot of bhalai, for lack of a better word, right? They went in with the approach of recognizing a problem that needs fixing. They recognize that so many people not being able to access credit in an efficient manner was just not fair and just not right, and it created a huge opportunity.
Makes sense. That answers my question. Yeah, please
I
can
think that's
carry on.
if you're building a for-profit business, having that lens becomes a little important.
Absolutely. Yeah.
Cool. Well, coming down to the last bit of the segment, the final thing that investors really stress test is the unit economics. And because this often determines how long you will stay standing in the battlefield. And the things that are relevant for companies in the smart protein space would be around what gross margins can you look to make, right? What is the cost of production going to be? What is the potential market price that you can charge? Because from these gross margins, you would need to pay out your channel margins. You would need to figure out what kind of marketing spend is required to educate the customer. If you're having to spend, like I said earlier, if you're having to spend $10 on marketing to help a customer understand that this is a good thing, and the customer is only buying $2 worth of stuff, and then you're having to go back and spend another $8 for that customer to again buy $1.50 of stuff, it's not a great it's not a great unit economics. And we've seen some of this in some consumer startups that have been talked about a whole lot um, in the media. And so figuring out what marketing spend makes sense for the potential sales that you want to acquire. Your lifetime value to cost of customer acquisition is something that becomes fairly important for you as a business, and for also from an investor's perspective as well. It really determines what you will be able to create in the longer run. There are also several companies where there is a massive scope for cost reduction as the company scales, right? So when you're just launching, you will need to spend more on acquiring customers. As you grow, a lot of your unit economics will start to change, because your probably you won't have to spend as much in acquiring customers. You will be seeing more organic growth, possibly because of customers referring other customers. You might see better cost structures on your logistics spend. And so understanding unit economics for the business is extremely critical. The kind of channels you choose will also drive your margins. If you are using your own website for sales, then you will not have capital that gets blocked. Working capital, you will be spending more on digital marketing, but not so much on margins that you give off to a modern trade partner, for example. And so the net money that you are making is something that investors will fundamentally grill you on. In fact, this is the segment that we spend the most amount of time for any startup that we look at. And for a lot of companies, early on, you might not have a sense of what the unit economics will look like, because you don't know how much you might need to spend on marketing in the beginning, how much you will need to possibly depend on influencers for catalyzing revenue. And while the unit economics are not necessarily set in stone, it helps us understand how the founders are thinking about various business metrics, and how will that understanding drive the business. And so having a sense of what unit economics will work for the business is very, very important, both for the founder as well as for the investor. And these all can vary on a case by case basis, because not everybody is going to be having the same cost of production. Not everybody is going to be pricing their product the same. Some people might negotiate outsourced production margins very, very aggressively. Some people might get very awesome deals on channel margins. Some folks might just tap the right influencer and use that to drive organic sales. And so how you win is very much determined on the various levels of your unit economics that you play on. Coming to the last bit, this is something I talked about earlier as well. Depending on the kind of business that you are, you need to choose the appropriate type of capital. Debt fundamentally is for businesses where you have visibility and assurance of cash flows. And so you don't need to give control over your business to anybody else. You need to pay a much lesser cost of capital, because you're not letting go of upside from your company by giving away equity. You will pay a 14%, 18% rate of interest comfortably from cash flows that you're making. You retain control of the company, and you grow in a much more stable manner. Venture capital, on the other end of the spectrum, is for companies where you will be growing much, much faster. You will basically have a hockey stick kind of a growth curve. And in exchange for that kind of growth and the risk that that entails, debt is usually for companies which have much lower risk profile. Venture capital is for companies which have the highest risk profile, right? Because these are companies which might fail tomorrow. These are potential ideas which might not work tomorrow. And so the returns expectations are also much higher. And in exchange for that kind of capital, there's a huge chunk of your upside that you have to share with the financier, right? For an early stage company, for a seed stage company, for example, you might have to give up anywhere between 15 to 30% of your company. And so when you make a 10x return using venture capital money, you have to share 30% of that return with somebody else. Whereas with a debt investment, you're not sharing your own upside or growth with anybody else. You're just giving out a stable, you're just making regular cash payouts. However, with venture capital, you you don't need to necessarily pay anything back, right? They will be, if everything becomes zero, it's a risk that everybody took with open eyes. Venture capital is also for companies which will not raise money from other conventional sources. In fact, the asset class itself came about because uh, back in the day you had uh, technology which started doing interesting things, and conventional financing sources found it too risky for their kinds of capital to finance. And so this new class emerged which was willing to finance such deals, um, you- in exchange for a nice share of the upside. In fact, the world's first venture capitals were the Spanish monarchs who would finance treasure hunting ships, and they would take a share of the treasures that were, that the ship would discover back in the 15th, 16th century. And that's the kind of risk return profile that we are talking about. So in fact, Mark often gives this example about how you need to choose the right kind of fuel for the vehicle. Venture capital is basically aviation fuel. If you put aviation fuel into a jet, it flies. um, if you put it into a car, it explodes. It can be a Ferrari, it'll still explode. And so choosing the right type of capital for the kind of business that you're building becomes very important. Also, it's extremely important, and I cannot stress this enough. The fact that a business is not VC fundable speaks nothing against the business, right? It can still be a great business. It can create huge value for the company, and everybody remains happy. And so not every venture needs to, or not every startup or every company needs to be venture capital backable. That's something that's very important to you understand. And it's also important to understand what capital brings to the table beyond just capital. And so because of the kind of risks that venture capital investors take, there's a lot of other value add that they try to bring to the table, in terms of helping with business growth, in terms of helping with hiring, in terms of opening doors with potential distributors or customers. And needless to say, it also comes with strings attached on when we get our exit, what are the kind of returns we want to make. There are certain affirmatives that we need to have for how the business will function. And so understanding all of that in understanding all of that together becomes very important when you decide what type of capital you want to raise. I think that brings me to the end, and happy to take questions.
Yeah, firstly, thank you so much. I think usually, so I got about 30, 40 questions from the registration form, and you've covered almost 80% of them through a lot of context via your slides. I think they were very rich in basic concepts that a lot of our attendees do not have an exposure to. So this is all value add. Given that, I think we have few more questions in, and we have about 8-10 minutes to go through them. So we can quickly cover a few. Um, I mean, these are basically questions in the Q&A section. I'm going to curate those really quickly for you. So
Sure.
if first question is, if somebody wants to launch products first in a test market which has more established market, UK, US, and probably manufactured in India, and then later build all of those brands and build all of the manufacturing capacity and then go after the Indian market, what funding mechanisms would you recommend in such cases?
So, firstly, it's also important to understand why would you look at launching in a market which is much more competitive? What is it that you're offering better, right? So, uh, if you have a price advantage, what is driving that price advantage? If it is an underlying technology that's driving that price advantage, um, venture capital is the right kind of asset class to, or rather the financing instrument to use. If it is something which is uh, which is being driven by low cost manufacturing in India, then potentially debt is a much better use of capital.
Yeah, that kind of answers the question. Also, I'll just take a quick moment. I ran a quick poll, right, when you're going through all the slides about how much relevant the content is for the participants. And I
Sure.
think the results are out, and about 80% found that 80% or more of the content was very, very useful for them. So we are all really thankful again just for taking time out and, speaking with all the challenge participants. Having said that, the second question would be, are there any recommendations when a lot of these participants have met each other through our matchmaking process now? Obviously some of them would fall off and they would not probably continue in those same teams working on their ideas, but we strongly recommend, obviously, the winning teams, especially the 5 top teams that would go into our demo day, we are going to strongly recommend them to work with those same teams, because you've gone through this whole 4-month journey. So I mean, there would be questions like splitting equity amongst co-founders, all of that. So any key books or any resources that somebody in that position should read?
uh, how to get a team to work together, is that the question?
Splitting equity amongst co-founders, just dynamics among co-founders, especially if they're raising VC money. Any books, any podcast, any recommendations for people to understand this aspect a little better?
So there would be, I'm sure there are resources available online, but I think it's a better idea to ask other founders with teams how they have gone about it. Usually, when the whole team is starting out together, it's better to have a more equitable, shareholding split. In fact, we would get worried if we see a team that's starting out together having a very having a major gap between each other's shareholding, right? In some cases where that becomes justified is if one founder is also putting in capital, um, and so generally starting, especially when people are starting, and if the founders have met each other through a matchmaking process, it makes much more sense to have a fairer, more equitable split, depending on the skills that both of them are bringing to the table.
Yeah, got it. And I think
If
I'll club.
if one
Yeah,
founder feels that the other should have a much lesser stake because the other is not bringing enough to the table, then boss, don't partner with that person, right? So starting when you're starting together, I think it makes sense to have a more um,
yeah,
even
I think that
if
answers me.
is okay. Cool. Does that help? Hello. think Shardul just dropped off. Let me look through some of the other questions as well. Yeah, hi.
Hey, sorry. I think I had a quick drop in the network. Just give me a second, okay?
Sure. Wow, I see a lot of questions here. Which ones do you want to take?
And we can maybe extend by 5 minutes if you don't have a call right after.
Sure, no worries.
Okay.
That's fine.
So, okay, the question which I was going to ask is a clubbing of couple of questions about price, taste, convenience are the key factors we also convey everybody to really think about. And scale is very
Right.
importantly tied into price and taste, right? Only then will a product really sell in the market. That is demonstrated everywhere. But what about nutrition in terms of also clean labels, like over processed ingredients versus nutritionally superior products? And can you talk about these two, three factors and how VCs look at it?
So, yes, clean labels are definitely, a trend forward. There's a lot of pushback even on like ingredients, which are fundamentally naturally derived, but still carry a whole lot of psychological block. So, there's definitely a push towards clean labeling, lesser ingredients, superior ingredients. Um, However, especially for India, it will not, they will never be more important than taste. People will not
Yeah.
have things that are healthy if they are not tasty.
Yeah, that's what we convey to everyone, right? I mean, price and taste should be solved for first, and then you can incrementally improve your product for nutrition,
Incrementally,
for clean
actually. So,
label,
for
all of that.
example, yeah, so for example, if two things taste the same, but one is a better for you alternative with like cleaner labels, with cleaner and superior ingredients, cleaner labels, and the pricing is not like exceptionally high, people might choose that product, right? If the price differential is not much. However, if you have something which is either super expensive or something that doesn't taste as well, then it'll be a challenge. So these two are must haves. Everything else is good to have. It improves your chances, but it will not help you overcome shortcomings in the other two essential categories.
Absolutely. And given that, obviously, if you do find a solution or a technology, especially because this is so tech forward and food science heavy field, right? The five categories that we are talking about. So if you do find a great solution, unique solution there to undercut your competition on, health or nutrition or better digestibility of proteins, all of those things, I think that those are very important modes, and they would certainly in those specific cases kind of overshadow other factors to certain extent. But obviously, what Shruti said is very correct. Okay, one quick question I can take. Do you have some ideas about general gross margins in branded CPG business? And again, one more question which was relevant to this was, I think, about listing fees and usually just getting those kind of insights on how much percent they usually take. Are they any better? Like in the long run, is that useful, or do you get your product out in a D2C kind of a mode right from the very start so that you save on those margins?
So, interesting questions. So, for branded CPG, given that you will need to spend money on channel and you will need to spend money on marketing, you need to make sure that your gross margins leave you enough to be able to foot all of these costs. And so, under 60%, if it's upward 60%, great. Under 50% becomes very difficult, and so that's the range that people should try to target, because you will end up spending anywhere between you know uh, 20 to 40% on your channel and marketing very easily.
Yeah,
For
yeah,
modern
makes a lot of
trade,
sense. Yeah.
they tend to take anywhere between 25 to 40%, depending on how you manage to negotiate. Different companies have had different levels of success with that. Some of them will charge one-time listing fee as well. The listing fee tends to be per SKU per store, and so every new store that you open, you need to end up paying fresh listing fee. Every new SKU that you launch, you might need to end up paying fresh listing fee. At the same time, there are companies which have um, unfortunately, given that it's not public information, I can't name them, but there are companies that have managed to really negotiate no listing fees.
Got
So
it. Yeah.
it comes down to how well you
So
negotiate.
yeah, I can add some couple of insights after speaking with multiple entrepreneurs in our sector. There have been a lot of cases where these modern retail format, or wherever listing fees is usually high, they're waived off a certain amount of that listing fee because the product was so innovative, right? You're truly offering a differentiation when compared to other products in the market. So those, again, like innovation and what category you're really falling in general, our sector is very new. So even that kind of, if you're using social media and if you build that aspect of communication and advertising and your first base of customers really well by delivering them online, then I think that just nudges the empty format stores to also give you a discount on the listing fees, because that attracts customers more.
Usually easier to get to that stage if you can already show strong existing sales. Because see, for the modern trade person, that 1 square foot of space is a whole lot of money, right? And if you have occupied that space and your product is not moving, if it's a new product or if it's something that's not sold enough in the market, he needs some sort of downside risk protection for that space that he has given you, because otherwise he could have just kept Maggie there and it would have moved, right? So he will also look at how he's monetizing that square foot of space. And so now that D2C is becoming a lot more attractive, I would definitely recommend that people explore that channel with the right skills.
Yeah, makes
See,
sense. I think we
when
can
we
take.
did have modern trade a couple of decades ago, 3 decades ago, you could not even think of new products coming into market, right? Everything, discovery was driven by television and radio advertising or newspaper and out of home banners. And fulfillment was driven by Kirana stores. And so if your local Kirana didn't have it, then Shah Rukh Khan advertising it on TV also didn't mean much. A lot has changed since then. Modern trade kind of bridged some of that gap because discovery became possible. Social media made awareness possible without having to spend the television advertising kind of money. And D2C is just a further evolution of that.
Yeah, yeah, makes complete sense. I think we'll just take one more question. There are few, but basically Indian traditional products, right? And people who are looking to innovate in that compared to burgers or patties or more
Right.
established Western concepts. Any preferences? Just some thoughts on that. How VCs usually would prefer that one over the other, etc.
Sure. So this ties to the first point that I made about consumption in Indian markets versus global markets. So when you look at traditional Indian products, uh, the things that you need to do to achieve a similar kind of product are actually much lesser. You don't need the mouth feel for muscle fiber is not needed, because India's traditional consumption, especially the more popular products that people pay a premium for, are kebabs and tikkas. And kebabs are in fact like completely ground, marinated to make as soft as possible. Even the desi curries that we make, uh, the we don't have meat which is rare. We have India consumes meat in a well done manner, and so you don't need to recreate a lot of those features which an Impossible or a Beyond needed to do. For traditional Indian products, that is not needed. Also, the desi non-veg consumption is driven by spices, and so there's a lot of flavor masking that the spices anyways already do. And so if you look at soy based products already had a lot of acceptance in Indian markets before, right? And so if you're looking at uh, building products for traditional consumption, then you need to make sure that your product can bridge the gap between Nutella and chicken.
Yeah, yeah, makes complete sense. These questions are so interesting. Just one final question, Shruti, and then we'll wrap up the webinar. Just about what kind of revenue multiples do VCs usually use, to get an enterprise value, as there's no uh, playbook or rule book for such in the Indian scenario, especially in the food tech CPG space.
So if you are a technology company, then it becomes very different, right? Then you actually get valued like a tech company. However, we've not really seen that kind of like uh, innovation in India so far. So most of these companies will actually get valued the way either a CPG company gets valued, or the way an ingredients company gets valued. CPG companies will typically get valued at anywhere between 4 to 7 times last 12 months revenue when they're mature. At early stage, it will be 4 to 7 times the annual run rate, which is basically your last month's revenue run rate into 12. For B2B companies, we've not seen a lot of VC backed B2B companies for ingredients in India. And our general sense is that they will either they attract a much lesser multiple compared to B2C companies, because B2C companies have the brand element built in. For B2B companies, you will end up seeing the 1 to 2x kind of revenue multiple. In fact, they're not usually valued on revenue, they're valued on EBITDA. And so B2B companies, you will end up seeing valued at around 12 to 15 times EBITDA.
Got it. I think fantastic insights all over. I personally loved sitting through this session and just curating all of
Thanks.
it. I learned a lot of new things as well, and I'm sure
Thanks for
everybody.
having me. I think this has been really interesting. I'm also very excited to see that there are so many people wanting to build solutions in the space. Um, Hopefully, we should see something coming out from here that is exciting for us as investors as well. Would definitely love to see more of that.
Absolutely. And just to tell you, all of the people, like 100 odd people who were there with us today, they'll go back and they'll. So usually people have made teams based on management work plus food science background. We recommended them to have some sort of a diversity. So I'm sure these insights are going to be relayed back in their team discussions and WhatsApp groups at night. And
That,
I'll make sure that we send this recording to everyone so that all of us can derive all the insights that we've shared today. Thank you so much, Shruti, for your time and joining us.
thanks for having me, guys. Have a good day.
Yeah. Bye,
Stay
everyone. Have a great day.